Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit homegain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to homegain.com.
You're listening to Real Estate Radio Washington, D.C. Metro with local expert Ryan Sloper. Now, here's Ryan.
Welcome back, Washington, D.C. Metro, to Ryan Sloper's Real Estate Radio. I'm joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder before we get started again, Real Estate Radio is designed to build the Washington, D.C. Metro's housing and credit markets one house at a time. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is via our off-air phone number. It's 877-245-2030. That's 877-245-2030. Reminder, that is an off-air number, so when you call that number, nobody will pick up the phone. Just leave a message, your name, phone number, and the best time to contact you back, and we'll get back to you by the end of the day. I want to jump in because we've had a lot of questions from listeners, emails and phone calls in from listeners in regards to, that's great that interest rates are low, and I want to take advantage of it refinancing my mortgage. But I've already paid into my 30-year mortgage by 6 or 7 years, and I don't want to start all over with that again. And Louis, this is a very common question among a lot of people throughout the country. Is just, they see the low rates, but they don't want to necessarily redo their loan because they want to pay it off without having to do that. And then they have a couple options. Let's say that they were in a 30-year fixed and they paid into it 7 years, so they're at 23 years now. They could just skip and do a 20-year because they're going to get even a reduced interest rate. Their payment might not move at all. It might stay exactly the same as where it's at, and they can knock 3 additional years off their loan.
And what were rates 7 years ago? Remind me, as a 30-year?
In what, 2003?
Yeah.
They were probably closer to, actually I just had a graph that I was going to pull up. Let's see here. Probably looking more around the 5 to 5.5 range.
Okay.
Somewhere in there.
I mean, if you do the math there, you could probably cut some years off and some point and a half, wouldn't you?
Yeah, and it obviously that's going to, a lot of the big thing here is, and this is why I try to tell people, you have to really not pay attention to what the media is telling you, because even though it could be a point and a half, depending upon your credit qualifications, it might not be that much. And I've seen certain people where they think that they're going to get the 4%, but then after you have to take in all the adjustments per Fannie Mae and Freddie Mac, then with the credit score, whether it's a cash out or not a cash out, their interest rate's a half or 3/4 higher than what we started at. So on certain situations, certain individuals, it's going to be one thing, and for others, it's going to be something different. But that's option number one, is to go down to a lower turn.
And Ryan, you're raising an interesting point. We've talked about this before. You listen to the media, you listen to the Fed, or whatever it is. You figure out what the economy is doing, which they don't even report on correctly anyway. But it's really, what is your economy?
Yes.
What specifically can you do? What rates can you get? What is your current situation? And that's why they need to reach out to you and get a real analysis of what's available to them. Yeah,
and I guarantee you, Louis, for all of our listeners out there, your situation is unique. It's unique to you and only you.
Yeah.
And
they try to make it sound like the economy is the economy, and they say this is where interest rates are headed. They don't know.
It's exactly when they start talking about home sales and they give you a national perspective. It doesn't do you any good. It doesn't do you any good if you're living in Washington, D.C. to listen to the national average right now, because we have something completely different, a different dynamic going on right now.
And home sales and home prices are different, as you point out all the time, versus cost of home ownership.
Sure. And this is like, a lot of the questions I'll get sometimes from listeners are, I'm looking to start investing in real estate. Where can
What does that mean?
What does that mean? Well, my next question to them is, do you have a certain return on investment that you're looking for? What are you looking for cash flow? Buying in the Washington, D.C. metro area might not be the wisest decision for where you're supposed to buy real estate investment, because there's certain areas of the country like Jacksonville, Florida, okay, where home prices are really low, but the rents are high. Okay, so you could
Arizona.
Yeah, same as in Arizona. So you could pick up a property for, let's say, $50,000 and then rent it out for $700 or $800 a month. That's a better
and pay $500 in mortgage.
Exactly. That is a better cash flow situation than buying a property here in the Washington, D.C. metro area, because you might not get the same return. Now, it all depends.
And you have to lay out a lot more money for a single.
Absolutely, but if you're talking about 20% down on a $50,000 mortgage versus $20,000 on a $200,000 mortgage, it's a lot less of outlay.
Right.
And that's why I said, everything is unique to where you live, what your financial situation is, what you're trying to accomplish, your short and long-term goals. For you guys out there that are trying to pay off your mortgage and do a term reduction loan, meaning you're trying to take a 30-year fixed and go to a 20, or go from a 20 to a 15 or 20 to a 10. Now is the time to do that. But I will tell you that if you do that, chances are your payment's going to be a little bit higher. If you were to go from a 30 to a 15, your payment's going to go up because you're almost kind of doubling the amount of principal that you're paying every month. And there's another option to that, and that's
why would you want to do that though?
And well, that's what I was going to jump into. Some people like the thought of knowing that their home is going to be paid off in the 15 years. Okay. And for whatever reasons, just to get rid of the debt. Some people just don't believe in debt. I can't really get mad at them for that. But you could actually, if you wanted to, you could actually just take a 30-year fixed mortgage, which the interest rate might be, let's call it 3/8 to a half higher than a 15-year fixed mortgage. If you want to, you can just pay that extra money. We can figure it out on an amortization schedule, what you would have to pay additional towards the principal each month to get it paid off in that amount of time. You have that ability.
It doesn't make sense, Ryan, to pay off debt when interest rates are next to nothing.
I do agree with you there, but
I'm asking a question. I'm not stating a position.
You think that? Well, I think it depends on what other debts they have. To be honest, Lewis, if it's if they have tons of other credit card debt, because sometimes people think that it's like, hey, I want to pay my home off, but they're not worried about their $60,000 in credit card debt. Obviously,
that you pay off first because the interest rates are much higher there.
That would be the first thing you want to pay off is obviously the higher interest rate. And
I know in the 70s and 80s people wanted to pay off their debt because interest rates are relatively high and they wanted to be free of that.
Yes.
But when interest rates are low, you might want to hold on to that low interest rate. I had the opportunity with my car loan. It was ridiculously low. I just never paid it off. I didn't want to accelerate paying it off. I paid it off over the course of the 3 years.
Yes. And, if you're like, how for a lot of car financing, if you can get the special, like let's say Honda comes out with a 0% for 60 months, it's like you have free money. So
why wouldn't you take that?
Yeah, exactly.
You can invest your money elsewhere, not in a CD.
Well, and in the mortgage, and that's why I said, once again, this comes down to the individual and what their goals are. If their goals are that they just want to be mortgage and debt free altogether.
Well, that's one way of doing it, sure.
That's one way to do it.
Not if they have credit card debt. They should want to be credit card debt free before they even think about paying off their mortgage.
Yes, I always advise pay a credit card, auto loans, anything that has the higher interest rates off first. Then when you arrive back to the mortgage, you can start to pay that down. There's a lot of people out there, Lewis, that actually live by the thing of, let's just get rid of the mortgage, take and rent that property out. I'm going to go buy another one and take out a mortgage. Now, granted, they're going to pay a higher interest rate on the next mortgage. But ultimately, if they were going to buy another property anyway, they were going to have to do that no matter what.
Right.
So, I think that the next generation moving forward, getting out of debt, whether it's credit cards, auto loans, mortgages, getting out of it completely is a smart decision. If our government would take the same approach, I think we'd be in a better shape than we are right now.
The only problem is if the government is doing that, they're actually favoring debtors over creditors, meaning that you don't get much for saving money, but you actually benefit from taking out loans.
Yeah. Well, you remember back when we had the low interest rates, probably 5-6 years ago, when Greenspan kept rates low for an extended period of time, just everybody over leveraged. Right. And, now we
overbought the stock market.
Yeah. And now we have low interest rates, but hardly anybody can take advantage of them because there's not as much equity in people's homes. And people are kind of stuck. Well, now what do? I really don't have any equity in my home, but I have, I want to do some other things. I mean, their options, some people want to try to pay their house off quicker. Some people want to take and put that money into the stock market. Some people just want to save and make really nothing in their bank accounts. I mean, everybody has their own things. And I think it really does take to sit down with the person, find out what their goals are. I really think that what I would suggest for people that that are considering refinancing, let's just say you paid into your loan 5 years on a 30-year fixed, you're going to save interest by just refinancing. So let's say you're comfortable paying the $2,000. You refinance out of a 30-year fixed at 5.5% and get 4%. Continue to pay what you were paying before you refinanced. Okay? If you do that, I will almost guarantee you that you will have not only made up the 5 years that you've already paid into it, but then some. And just because of the amount of interest that you're saving over the long term of the loan. Just continue paying what you're currently paying, but refinance your loan to the new low mortgage interest rates. So if you're comfortable paying that $2,000 a month, continue paying the $2,000 a month. I would guess that you'll probably, if you continued paying that with the lower interest rates, you're probably going to have that loan paid off in about 18 to 20 years versus the 25 that you were on track currently to pay it off in. Now, that makes sense, Lewis, just because of the way that mortgage interest is front-loaded anyway, that you can eat into it, and you could actually slow up once you get to a certain point. You know what I mean? Because for the first, you don't typically pay down on your mortgage the halfway point until I believe you're like 21. So if you can offset that initial interest, which is all front-loaded on the mortgage, and you could really start paying it down in the beginning to principal, every payment that you make thereafter, more and more of that money is going towards the principal. So I do advocate doing that, Lewis, because one extra payment per year for you out there that are looking to speed up, pay off of your loans can take your loan from a 30 to a 22 by one extra payment per year. That's not biweekly payments. I am not actually an advocate for biweekly payments. And the reason why I'm not is because what does the bank do? They take your money bi-weekly, put it in an account, and basically just credit to your account one time a month. So they're just holding your money. They're holding your money. Why not you hold your money and determine when you want to make one extra payment per year?
If you could do annual payments, that'd be even better.
You can make it, you could break that up. Let's say the payment's $2,000. You could say, okay, 2,000 divided by 12 and put that additional amount towards the principal each month. Or a lot of people, when you get your tax refund check, take one payment and put it towards your mortgage. You're cutting 8 years off the life of your loan. Makes sense to do.
No, it does. What I was facetiously saying was that why pay twice a month if they want you to pay? You can pay once a month. But I'm saying if they let you pay once a year, you'd be better off there too.
Absolutely. When we come back, is there a 3.8% tax on homes in the health bill? We'll let you guys know that when we come back.